Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special report brought to you in association with ASB. Today we're going to have a look at the US 10-year Treasury bond. Now don't turn off, this really is important and I can explain to you what it means for interest rates, particularly mortgage interest rates here in New Zealand. Now we all know Barack Obama has been planning a huge spend up to get the US economy going again. And the US budget's been in deficit for some time and it's now being ramped up significantly. What does that mean? Well, the US government has to go out into the world markets and borrow money from people by selling US Treasury bonds. This week, the US government is planning to sell $67 billion worth of these Treasury bonds. And when that happens, investors want to pay a low price. It's like anything. When a huge amount of supply comes onto the market, the people who are buying want to see the price cut. Now, in bond terms, when the price is cut, the yield increases. Essentially, people want more return for their money. So what we've seen in the last couple of weeks, as global investors have finally worked out there's going to be a huge wave of government bonds come onto the market, they have pushed the yield on treasuries up significantly. We've seen the 10-year Treasury bond yield rise from just over 2% before Christmas to over 3% in the last few days. This is a significant move. Now there's a couple of things happening here. Obviously, huge supplies coming onto the market. People realise the governments around the world are going to be borrowing heavily. But we also need to watch what's happening with the US Federal Reserve here. Now we all know the US Federal Reserve has cut its official cash rate, its version of the OCR, to basically 0%, and it's got no way to really get the economy going again now that it's cut so low. So what it's looking for is some sort of unconventional way to pump money into the economy. And one way to do this is to buy assets off people, essentially to hand them cash for the stuff. Now they can buy directly in the markets, they can buy mortgage bonds, so this isn't treasuries, or they can buy treasuries. And the big debate going on right now is when will the Federal Reserve jump into the market and buy treasuries and push that yield down again? It is the big question, and when it happens, the world will shake because long-term interest rates will, in theory, at least stop rising or maybe even fall. There is some debate going on, though, within the Federal Reserve about how to do this, and people are getting a bit nervous about it. It's certainly one to watch over the next couple of weeks. When will the Federal Reserve jump in and start buying US Treasuries? Now, why is this important for interest rates here in New Zealand? Well, the US 10-year Treasury bond yield is a bit like the base for all interest rates globally. And often interest rates are priced off this base. And New Zealand interest rates are the same. We have our own wholesale markets, but in the world of interest rates, they are based off those US bond yields. And it's something for us to watch, therefore. So when US interest rates, long-term interest rates, 10-year bond yields start rising, then our longer-term interest rates start rising, and in particular for mortgage rates, particularly longer-term fixed rates. So if you're looking for a 5-year mortgage rate, or even a 2 or 3-year mortgage rate, I wouldn't expect that to fall too much more than it's at the moment. It's unlikely, I think, that we'll see 1, 2 or 3-year fixed mortgage rates much below 5% or even below 5%, even if the official cash rate is cut to 2% or lower. Now you may wonder, hang on a minute, we've gotten used to fixed rates, 1, 2, 3-year fixed rates, being lower than the variable rate. Well, I think that's about to change. The variable rate is going to keep following the official cash rate down. That may even get down to 5% or maybe even a tad lower. So we'll see in the future variable rates, variable mortgage rates, and fixed mortgage rates being about the same. Potentially, variable could even drop below fixed, and we could have that positive yield curve we talk about. So, there we have it. One to watch, the US 10-year Treasury bond yield. It's rising fast. We need to watch for the US Federal Reserve to go in there and jump in and buy those bond yields to pump money into the economy. And we have to watch that relationship between the Treasury bond yield and our mortgage rates. So there we have it. Some excitement around the 10-year Treasury bond yield. I'm Bernard Hickey for interest.co.nz. That was a special report brought to you in association with ASB.